Hi everyone, welcome back to Difference Frames the World, the channel where we break down global affairs and financial stories through a different lens. Please subscribe to the channel and enable notifications so you don't miss our daily uploads. Here is Clara again, and today we discuss something that might sound technical at first, but it's actually a window into how China sees itself in the global financial order. It's about China's $4 billion sovereign bond sale in Hong Kong. It is not a dry story full of numbers. Please stay with me and let us delve into the details, because behind those numbers is a story of confidence, strategy, and geopolitics, wrapped up in one financial move. Let's start with what actually happened. In early November 2025, the People's Republic of China, through its Ministry of Finance, issued $4 billion sovereign bonds in Hong Kong. It wasn't the first time China has taken this step. But the timing and the scale make this particular issuance especially interesting. The global economy is still shaky. Inflation is lingering in the US, while Europe is juggling energy and debt issues, and emerging markets are watching as capital flows out. So when Beijing decides to issue dollar-denominated sovereign bonds in Hong Kong, it's sending a clear message. We're stable, we're confident, and Hong Kong still matters. The issuance was advised by global law firm Linklaters, structured under two frameworks, Rule 144A and Regulation S. Rule 144A allows China to sell these bonds to large institutional investors in the United States, such as pension funds or hedge funds. Regulation S primarily covers investors outside the US, including those in Asia, Europe, and the Middle East. In short, these two rules open the door to global capital. The bonds came in two tranches, with 3-year and 5-year terms, and both were denominated in US dollars. By using the dollar, Beijing is appealing to investors who want exposure to China, but without currency risk from the RMB. Now comes a question: why issue these bonds in Hong Kong, rather than in Shanghai or Beijing? The answer is part financial, part political, and part symbolic. First, Hong Kong remains China's gateway to the global financial world. Even after years of tension, protests, and policy changes, Hong Kong's capital markets are still the most internationalized within Chinese territory. Foreign banks are there. Global investors trust its legal system. The infrastructure, clearing, settlement, and exchange connectivity are world-class. So, issuing the bonds there sends a powerful message. Hong Kong isn't just surviving, it's still central to China's global finance strategy. And it's not just symbolic. Each offshore bond sale helps strengthen Hong Kong's liquidity and its role in both the US dollar and offshore RMB markets. That's why, even as mainland cities like Shanghai are rising, Hong Kong remains irreplaceable when it comes to connecting the Chinese capital to the world. In the first 10 months of 2025, global bond markets experienced significant volatility. The US Federal Reserve was still battling inflation, and Treasury yields were near multi-decade highs. For emerging markets, that's usually bad news. Money tends to flow out of riskier assets and into the safety of US Treasuries. And yet, China's bond sale was oversubscribed nearly 30 times. That means there was significantly more demand than the $4 billion China was offering. Investors lined up from sovereign wealth funds and central banks to global asset managers and private banks. Why? Because China's credit is still viewed as solid, although US rating agencies are not particularly favorable to China for various reasons. The PRC holds massive foreign reserves, maintains a manageable fiscal deficit, and despite slower growth, it's viewed as a low default risk economy. In other words, it's a safe bet in a risky world. China comes along with bonds yielding slightly higher returns, backed by one of the world's largest economies, and structured transparently under familiar US and international rules. China's sovereign bonds are still rated A+ or A1 by major agencies, offering a stable spread opportunity, with a higher yield, moderate risk, and global legitimacy. And for funds seeking Asian exposure, it's a perfect fit. Now let's flip the lens and look at this from Hong Kong's perspective. This bond sale wasn't just good business, rather, it was a strategic validation of the city's financial relevance. Over the past few years, Hong Kong's reputation has taken some hits. Critics said its golden era as Asia's global financial hub was fading, and that Shanghai, or even Singapore, would take over. But this deal says otherwise. By choosing Hong Kong as the platform, Beijing reaffirmed its trust in the city's deep markets, strong governance, and international reach. And here's the kicker: each sovereign issuance like this helps anchor other issuers. It gives banks, state-owned enterprises, and even foreign companies in China a pricing benchmark to follow. That's crucial for keeping Hong Kong's bond market vibrant. It's like lighting a financial lighthouse. Once the central government issues it, everyone else can navigate around it. Let's zoom out a bit. Why is this happening now? China's economy in 2025 has faced numerous challenges: slower growth, property troubles, and soft global demand. However, the data from the first 3 quarters showed signs of stabilization. Exports increased, inflation remained low, and the central bank maintained relatively tight monetary discipline. So this issuance wasn't about plugging a fiscal gap. It was about showcasing fiscal discipline and stability. It's like saying to the world, we're not borrowing because we have to, we're borrowing because we are creditworthy and trustworthy. At the same time, China's long-term goal of internationalizing the RMB depends on maintaining a strong offshore liquidity. Even though this bond is in US dollars, it indirectly supports that goal by keeping Hong Kong's financial plumbing active and credible. This transaction was legally advised by Linklaters, a top-tier global law firm with a long relationship with China's Ministry of Finance. Their involvement ensures the bonds meet international compliance standards under both US and Hong Kong laws. That sounds like a minor detail, but it's a significant factor in why international investors are comfortable purchasing Chinese sovereign bonds, because they're structured under rules they understand. Beijing is playing on the same financial field as everyone else. Now, let's consider the broader implications, the signal it sends globally. Over the past few years, the narrative in Western media has been that China is decoupling from global systems, building its own parallel world. And yet, here we are, Beijing issuing bonds under Western regulatory frameworks, in a Western currency, through global law firms, to international investors. That's not decoupling. That's selective engagement, China on its own terms. It's a way of saying, we'll participate, but we'll do it from our home base, Hong Kong. To understand how this fits globally, let's compare the US and China. In 2025, the United States issued over $1.8 trillion in treasuries. China's $4 billion looks small in comparison. But scale isn't the point. Unlike the United States, which issues debt to cover deficits, China's goal is credibility building. It sets benchmarks, tests investor sentiment, and maintains its global presence. It's like running a victory lap every year, not because you need the exercise, but because it reminds everyone you're still in shape. Financial analysts across Asia and the West had similar takes on the deal. Bloomberg Asia called it a reaffirmation of financial openness. Reuters said it showed confidence in China's fiscal management. And the South China Morning Post pointed out that Hong Kong remains irreplaceable for international finance. They saw it not as a desperate grab for cash, but as a measured, confident move from a country that still wants to play by international rules on its own stage. Still, we see risks. While central government bonds are clean and well documented, China's broader debt picture, especially among local governments, remains murky. Geopolitical tensions could also flare up again, especially if US sanctions target financial channels. And then there's competition. With US Treasuries offering high yields, China must remain attractive enough to attract investors, even if the US government is no longer as trustworthy as it was previously. However, the risk is manageable, and the reward justifies the bet. That is why the order book was about 30 times oversubscribed. Market watchers expect Beijing to continue issuing sovereign bonds in Hong Kong every year, not just in dollars, but also in offshore RMB. There's also growing discussion about the international sovereign green bonds, which align with China's carbon-neutral goals, and could attract ESG-focused investors who seek both yield and sustainability. As more international funds participate, Hong Kong's position as Asia's bond capital will only continue to strengthen. This $4 billion issuance is more than just money. Frankly, $4 billion means nothing to the Chinese economy. It's about narrative control. About shaping perceptions. At a time when many headlines portray China as turning inward, this bond sale shows a different reality, one of measured engagement, calculated confidence, and strategic openness. For Hong Kong, it's a breath of validation. For investors, it's a sign that China's fiscal credibility remains intact. And for Beijing, it's proof that global finance is still a stage where it can perform and be heard. So, next time we see a headline about China's bond sale, remember, it's not just about interest rates and yield curves. It's about strategy, symbolism, and the quiet art of financial diplomacy. The Chinese sovereign bonds in US dollars have the similar or slightly higher rate than the US Treasuries, and the $4 billion deal attracted nearly $120 billion to subscribe. In contrast, the US Treasury finds it difficult to convince enough investors to fund its deficit. Does it sound funny? Do you believe the Chinese government is more creditworthy and gains more trust from investors worldwide? Please put your answers in the comments section so that other viewers can benefit from your insightful opinions. Thanks for watching, and see you tomorrow. Please subscribe to the channel and share the video with your friends, helping DFTW grow into a 1 million subscriber channel soon.